Discover the tips and strategies that will help you achieve your retirement goals. I'm your host, James Knoll, and this is the podcast dedicated to helping you retire well. It all starts right here on Ready for Retirement. Hi everyone, and welcome back to another episode of Ready for Retirement. I'm your host, James Knoll. And on today's episode, we're going to be talking about Roth conversions, but probably in a different way than we've talked about them before, or a lot of people have talked about them before. There's almost this sense of I'll see people either doing far too little with Roth conversions, and they're leaving a bunch of money on the table because of extra taxes they're going to end up paying as a result of this. Or I see other people who are so dead set on converting so much money from their pre-tax accounts to Roth accounts that they're likely going to end up paying more in taxes over the course of their lifetime because of some of these conversions. So on today's episode, we're going to be talking about how important are those Roth conversions? How do you find that balance in how much you should be converting, especially in light of the fact that tax legislation is going to change? And if nothing changes, we know for certain that current tax law will sunset at the end of 2025. So this podcast is the result of a question that was submitted by Carl. And Carl said this. He submitted a question to the podcast saying, I am 60 years old and getting ready to retire next month. I have $2.2 million in an IRA and $150,000 in a brokerage account. When I leave my company, I will have a $900,000 401k that I will be looking to move out. My wife passed away a little over a year ago, and I will start collecting Social Security survivor benefits of $1,955 per month. Should I roll the 401k into a Roth? It will be almost $300,000 in taxes, but I am a little concerned about RMDs when I hit age 72. I will be switching to my Social Security when I turn 70. Until then, I plan to withdraw the max I can and stay in the 22% tax rate. This should be about $70,000 per year. Well, Carl, thank you very much for that question. I'm very sorry to hear about your wife passing last year. So what I want to do on today's episode is help to understand specifically as we're talking about this, how should Carl be thinking about this, but then more broadly and more generally speaking, how should all of us be thinking about this when it comes to our retirement planning? Side note, as always, none of this should be construed as advice or specific recommendations. This is just going to be looking at this from a few different perspectives so you can get a sense of a framework that you might be able to apply to your own situation. Before we jump in, I did want to highlight a recent review. This review is on Apple Podcasts. It's from Rozillat. It's Rozillat. I'm not sure if I'm pronouncing that right, but username Rozillat says clear and complete in his 5-star or her 5-star review. I've been listening to the Ready for Retirement podcast in serial in connection with my recent retirement. These podcasts are by far the finest resource I have found. The clear and complete approach to such a wide variety of topics has helped me think through a myriad of issues. Rozillat, thank you very much for that review, and I always appreciate when you leave reviews. It means a lot to me. I get to read these, and it helps more people find the show, which is ultimately the goal of doing this as well. So make sure you've left a review if you have not. Make sure you've checked out our YouTube page if you have not already. It's called Root Financial Partners. That's my company name. And with that being said, let's jump into today's episode. So here's what we know. Let's take a big step back real quick to talk about why we're even doing this. The goal of Roth conversions is to pay taxes at a lower tax bracket, not at a higher tax bracket. Seems simple enough. Well, with your investments, when you're in retirement, you have control over when you pull funds out and how you recognize income, especially if you have different types of accounts or different investment account types. So with that, because you have that control, you have the ability to an extent to determine how much you pay in taxes each year when you're pulling money out of your investment accounts. That control, though, it goes away, or it at least becomes much less when you turn 72. Because at age 72, any of your pre-tax accounts that you have, whether it's a traditional IRA or 401k or 403b, with some exceptions if you're still working at the companies, but in general, if you have pre-tax accounts, you're going to be required to start taking funds out of those accounts. So that control that you had of determining when you want to realize income based upon what accounts you pull from, that control goes away for a little bit. So the art is to balance, when are you pulling funds out? Should you be pulling them out when you turn 72 and beyond and you have your required minimum distributions? Or should you be doing conversions along the way to try to pay taxes at a lower tax bracket and avoid the bigger tax that you're going to face in the future? This is especially important because what we know is at the end of 2025, unless new tax legislation is passed before then, current tax law is going to expire. each tax bracket that we have today on average will go up about 3 to 4%. So for example, today our tax rates are 10%, 12%, 22, 24, 32, 35, and 37%. No need to memorize those numbers, but that's just the current tax brackets. These are just federal brackets, of course, but that's where we currently pay, or that's what we currently pay. If these brackets were to sunset at the end of 2025, the 10% bracket stays at 10%, but 12% goes to 15, 22% goes to 25, 24% goes to 28. The other tax brackets, they're going to be a little bit different, but they will go up as well. And not only will the tax brackets go up, but potentially the amount of income that you need to recognize in order to go up into the next tax bracket might be compressed a little bit. Meaning even if the tax bracket isn't rising, you're going to be paying taxes at a higher rate for the same level of income you otherwise would have been paying taxes at. So there's going to be a little bit of a bump here. This bump could be next to nothing, or this bump could be up to about 4%, or potentially higher if new tax legislation is passed. So a lot of people are looking at this and they're saying, okay, we have relatively low tax brackets today compared to where they've been, compared to where they're going. Does it make sense to do a lot of conversions? So again, going back to our goal here, the goal is to pay taxes when you can pay taxes at a lower tax bracket as opposed to paying taxes when you're going to be in a higher tax bracket. This is the whole strategy behind doing Roth conversions. Doing a Roth conversion means you're pulling more money out of pre-tax accounts today and you're converting those funds to your Roth IRA, well, they'll grow tax-free forever, versus allowing them to continue to grow in your traditional IRA and then pulling them out and pulling out a larger amount when you have your required distributions and paying taxes then. Now, here's the thing. If your marginal tax bracket today is the same exact marginal tax bracket you're going to have in the future when you take your RMDs out, it really doesn't matter. It would just come out in a wash. So, for example, let's say you're going to do a conversion today, and let's assume that the taxes, the federal taxes on that conversion would be 10%. Use that number because it's very easy for me to do that math. So 10%, let's say you do a $1,000 conversion today. That means you'd pay $100 in taxes and $900 would then be growing completely tax-free in your Roth IRA. Let's assume that $900 between now and when your RMDs start, let's assume it grows and it doubles in value. So what happens is your $900 that's now in your Roth IRA, it grows to $1,800 and that $1,800 is completely tax-free. That's the after-tax amount. Now, compare that to a scenario where you don't convert today, and that $1,000 in your IRA just continues to grow in your IRA. It also doubles. So that $1,000 grows to $2,000. Well, now if I have to take that out as an RMD, and if I'm paying 10% taxes on it, that $2,000 after 10% tax turns into $1,800. That's the after-tax amount. So in both of these equations, or both of these scenarios, the after-tax amount is exactly $1,800, which shows if tax brackets are the exact same, this does not matter. It's really what you're trying to do is convert when you're in a lower tax bracket to avoid paying taxes when you're in a higher tax bracket. So here's the thing, here's the feedback I always get. People say, yes, James, of course, but you wouldn't actually pull funds from your traditional IRA when you did that conversion. You would use maybe a separate account or a cash to pay that $100 in taxes in your example. That's true. You would probably actually do that. But in that scenario, you can't just pull in that extra $100 in one scenario to show the Roth conversion working out better without also adding $100 to the other scenario. So for example, if you wanted to rerun that scenario and say, okay, I have $1,000 that I convert and I take $100 of my cash to pay taxes to allow my $1,000 to continue growing tax-free in my Roth, you would also have to add in $100 to the other scenario where you don't convert and see what would that $100 grow to. Well, if it also doubled in value, it would grow that $100 to $200, which again makes the equation come out in about a wash. So just a side note there, yes, you probably or you ideally use outside funds to pay for taxes on the conversion, but this is just showing the principle or the analysis of it, that if tax rates stay the same, it doesn't really matter as much. There's still some things that it impacts, but it doesn't really matter as much whether or not you do the conversion. So let's look at Carl's example now. His goal is to pay taxes at lower levels, not at higher levels. And here's what he says. He has funds in an IRA. He also has $900,000 in a 401k, and he's asking if he should move that 401k into a Roth, which would make it a fully taxable conversion. If you have $900,000, if you have any amount in a pre-tax 401k, and when you leave your company, if you roll that into a Roth, it's automatically going to be treated as a conversion. So Carl says the taxes on this will be $300,000. My basic math here shows it might be a tad bit more than that, but I don't know Carl's other income sources. I don't know the full tax picture. So let's just go with this. Let's say that the total taxes on this are $300,000, which would be a 33% effective tax. So $300,000 divided by $900,000. Now, this is not including any state taxes. So either Carl is in a state where there are no income taxes, or that's not included in this projection. So I would say, Carl, if you are in a state where there are income taxes, make sure that you're also factoring that as well. But if you're in a state like a Florida or like a Texas or like another state where there is no state income taxes, all you really need to look at is the federal taxes. So if Carl were to do a full conversion of the full $900,000 in his 401k today, his effective tax on that would be 33%. Effective tax is just dividing the taxes paid, so in this case $300,000, divided by the total converted amount, which is $900,000. So 300 divided by 900, 33%, that's where I'm getting that number. So that's the effective tax bracket. The other tax threshold to be mindful of, or tax number that you should be mindful of, is your marginal tax bracket. The marginal tax bracket says for each additional dollar that you convert, or each additional dollar of income, what tax rate are you paying taxes at for that dollar? Well, the marginal tax bracket today, Carl would be in the highest bracket, which is 37%. So just to summarize, if he were to do this, the effective tax rate would be 33%. The marginal tax bracket would be 37%. Well, the analysis can't just stop there. You can't just look at what would this look like today. Really what we're trying to see is we're trying to compare this to what would things look like in the future if Carl didn't do this. So we can get a clear sense, we have a clear sense already, what might the approximate tax impact be of this. But to really do the full analysis, we need to understand if Carl didn't do this, what might that future look like and what might his tax brackets be in that scenario. So I don't have enough information to know exactly what Carl's income is going to look like in the future. I don't know where tax brackets are going to be in the future. There's a whole bunch of stuff we just don't know. But let's look at a very basic analysis. Here's what we do know. We know that Carl today is collecting a Social Security survivor's benefit, but he mentioned he's going to switch over to his own Social Security benefit at age 70. I don't know what Carl's Social Security benefit would be, but let's just assume it's the max, just to see what's the kind of quote-unquote worst-case scenario in terms of tax impact. Well, today, the max Social Security benefit at age 70, so if you've maxed out your earnings for 35 years, you would receive $4,194 per month from Social Security at age 70. Now, one of the nice things about Social Security is it's not all included in your taxable income. A maximum of 85% of it is included in your taxable income, which means that if Carl's receiving $4,194 per month in Social Security, the taxable amount of that would be $3,565, which on an annual basis comes out to about $42,780. So that's the amount that Carl would be paying taxes on with Social Security, or that's the amount that's included when Carl goes to calculate what his taxable income is. Now, on top of that, when his required distributions begin, Carl's going to have to start taking funds from his IRA. So in this scenario, I'm assuming what if he does not roll over, or what if he does not convert his 401k? What if instead he just rolls that over to his traditional IRA? Well, in that case, we know that he currently has $2.2 million in an IRA. If he rolled over $900,000 from his 401k, he would then have $3.1 million. Now, that balance could, of course, grow. It could be doing a whole bunch of things between now and age 72. But because I don't know how much he's going to spend down, I don't know how much he's going to convert, I don't know what the growth rate would be, let's just assume for super simple numbers, it stays at $3.1 million by the time he turns 72. Well, the required distribution, if I look at the IRS Uniform Life Expectancy tables for RMD calculations, the required minimum distribution at age 72 on a $3.1 million portfolio would be about $113,000. Obviously, the portfolio is probably not exactly $3.1 million at that point. If it's 20% higher, well, increase the RMD by 20%. If it's 50% higher, increase the RMD by 50%. But just using some basic numbers, $113,000 is the RMD we could expect that first year. Now, of course, that might go up a little bit, or it will go up a little bit each year, depending on what the portfolio balance does. But what we know now for Carl is if it's just Social Security and RMDs at that age, then his total income would be $156,000, which is the taxable portion of his Social Security plus the required minimum distribution, which is also fully taxable. Now, At that time, if we're just using deduction amounts or tax tables today, he would have a standard deduction of $14,350. So that's your standard deduction if you're over 65, which means his taxable income would be $141,650. So total income $156 minus the standard deduction, taxable income of $141,650. I know these numbers are not precise. I know a lot's going to change over time, but just want to illustrate for you how to look at this, because a taxable income of $141,650 today, at today's tax brackets, that would put Carl in a marginal tax bracket of 24% compared to 37% if he converted all of his 401k balance today. And his effective tax rate would be around 18% compared to 33%, which is what his effective tax bracket would be today if he were to convert the entirety of his 401k. Even if current tax brackets sunset at 2025, well, his marginal tax bracket would go from 24 to 28%, but it would still be less than the 37% he'd pay today, and his effective tax bracket would still certainly be lower than the 33% that he would pay today if he converted everything. Now, some major disclaimers here. Carl's RMD amount could certainly be a lot higher. In this analysis, I was just looking at current tax brackets and the current value of his IRA. Both of those are major variables that could change this. His IRAs could grow quite a bit. And of course, the more they grow, the more his required minimum distribution would be in the future. But I think they would need to grow fairly substantially to make converting the whole 401k make sense in this analysis, assuming similar tax brackets. His RMDs also could be lower. If he's implementing conversions, or maybe he's spending down his IRA balance, those could be things that could lead to a required minimum distribution being lower. Congress could push the RMD ages back. This was something they did fairly recently. Not too long ago, the RMD age was 70 and a half years old. Now it's 72. There is talk of that potentially being pushed back even further. So things like that would certainly impact this analysis. And the biggest one, or one of the biggest ones, is certainly who knows what tax rates will be at that time. Will they be the same? Will they be higher? Will they be lower? We just don't know, but we wanted to take a look at this to show how do we compare, how do we determine if a Roth conversion makes sense? Well, for starters, it's easy enough today to understand the impact of making a Roth conversion. You can run a projection, you can see what your total income will be without a conversion, then you could see what would be the tax impact of making that conversion today at today's tax brackets. That's easy enough. The harder part is projecting out into the future of what will your tax situation look like at that time, which is going to be a combination of things like how much growth are you getting on your IRA or pre-tax account balances? What conversions are you doing along the way? How much are you spending down your pre-tax account balances? What happens to tax rates? What are your other income sources? So it is certainly something that's doable and certainly something that you should be looking at to at least get a general sense of that comparison. But it's a lot harder to determine where will tax brackets or what will the impact of RMDs be in the future versus the impact of a conversion today. So with all that being said, what are the takeaways from today's episode? Not just for Carl, but for everyone. Well, here's the things I want you to focus on as you're looking at, does a conversion make sense for me? And not just does it make sense, but to what extent does it make sense? Number one, the first thing is to optimize your finances. Only make Roth conversions that make sense. To go back to that last example, if today you're in a 22% marginal tax bracket, and in the future at RMD age you're projected to be in a 22% marginal tax bracket, it does not make much of a difference whether you convert or not. So seek to optimize your finances by doing those conversions where you could pay taxes at a lower rate today on the conversion amount than you would expect to pay in the future. Number two is it could make sense sometimes to look at conversions as tax insurance. Well, what do I mean by that? We don't know where taxes will be in the future. If you're 60 years old and you're listening to this podcast, there could potentially be 4 different presidential administrations, including the current Biden administration, between now and your RMD age. If they only go for one term each, we could potentially see 4 different administrations, which could potentially mean 4 different sets of new tax legislation. So we can project and we can assume and we can run different projections at different rates, but at the end of the day, we just don't know where brackets will be in the future. Because of this, I sometimes like to view Roth conversions as a form of tax insurance. Here's what insurance is. So just to use a quick example, I hope that all the insurance I pay for, life insurance, health insurance, disability insurance, car insurance, etc., I hope that it all becomes a gigantic waste of my money. I really hope that my wife never has to cash in my life insurance policy. I hope those monthly premiums that I pay completely go to quote unquote waste because I never need them. So what insurance does is insurance helps us to mitigate worst case scenarios. So if we're looking at tax insurance, you could view any Roth conversions and the taxes that you pay today almost like tax insurance, because what it's doing is it's giving you a known quantity of taxes that you're going to pay. And it's almost insurance of what could potentially go wrong, of what tax rates could potentially rise to. And it's almost your way of saying, I am willing to pay this premium. I'm willing to pay this level of taxes today in order to protect against what might potentially happen down the road. Now, just like life insurance or health insurance or whatever else, if tax rates don't increase as much as you think they might, or if tax rates go down in the future, well, that's not necessarily a bad thing. It's kind of like saying, great, I'm not cashing in my life insurance policy. I'm not cashing in my disability insurance policy. It means that things have gone well and every other aspect of my financial plan is going to continue to go better. And I'm okay with this being a quote unquote waste of money if I reframe it as tax insurance that helps to mitigate the worst case scenario. So of course, worst case scenario with taxes going up isn't the same magnitude of risk or devastation as a disability or death or health event, but it still does sometimes help to view it that way, even if it's not necessarily, to go back to point number one, the absolute best optimized way to look at our finances. It is mitigating the risk of taxes increasing. The third takeaway for this whole analysis is this isn't for everyone. I think people get hung up, or they understand the value of a Roth conversion and they understand the risk of, oh my goodness, what happens if RMDs happen and I get pushed up in this tax bracket I don't need to be in. That's actually for a smaller subset of people that actually have to be concerned about this. For example, if you have $300,000 in your IRA, which is a decent chunk of money, if you have $300,000 in your IRA at age 72, your RMD that first year of required distribution ages, based upon today's tables, would be $10,949. Now, stack that on top of Social Security or maybe a pension or maybe some savings, it's probably not going to put you in a huge tax bracket. If it does put you in a huge tax bracket, then it means your RMD or your IRA is probably a relatively small amount of your overall plan. You probably either have other investments or assets or resources that you're living on, and your IRA is one minimal part of that. So RMD mitigation through Roth conversions maybe don't help a whole lot anyways. But in that sense, your RMD that first year, it's going to be relatively small, just under $11,000. Even your RMD your 10th year, so by age 82, if your IRA balance is still at $300,000, it would be just over $16,000 that you'd have to take out that year. So probably not a significant amount or a significant enough amount to fully derail or to fully push you into a tax bracket that you don't really want to be in. And the point here is if you don't have a fairly substantial pre-tax portfolio, then you might be stressing out too much about Roth conversions. You might be just fine letting this be something that doesn't take up too much of your attention, because you might just be fine even if you didn't do any Roth conversions. Now, compare this to someone who has $3 million in their IRA, not $300,000. Multiply all those RMDs by 10. The RMD that first year of required distribution age, it's $109,000. That RMD, the 10th year, is $162,000. And again, these amounts stack on top of whatever income sources you already have. Here's the other thing too. If you're going, on average, if you're going into retirement with $300,000 in your IRA, more often than not, that's being spent down, meaning your IRA balance is somewhat staying quote unquote managed, where it's not rising to an unmanageable amount because you're living on that money. You're probably needing that required minimum distribution to support some of your expenses. If you have $3 million or $4 million or $5 million in your IRA or pre-tax balances, there's probably more money in that account than you necessarily need to live on, which means it's going to continue growing and continue becoming more and more and more unmanageable. So that compounding is going to tend to continue more for the person who has $3 million in their IRA balance than that person who has $300,000 in their IRA balance. So the third point I want to make with all this is understand that this isn't for everyone. For some people, there's significant planning opportunities. For other people, give yourself almost permission to understand maybe you don't need to worry about this as much. I wish there was a magic number of if you have more than X amount in pre-tax accounts, worry about this. If you have less than X amount in pre-tax accounts, don't worry about this. There's just really not. There's just too many other variables that go into this analysis of your other income sources, the taxation of those income sources, your other assets, the taxation of those assets, your filing status, the growth rate you can expect on your accounts, your expenses in retirement, your overall goals in retirement. There's too many variables that make it impossible to say, here's that magic number of when you should or should not worry about this. But I will say that I run across quite a few people who come to me because they have this burning desire to do Roth conversions and they're scared of what the future might hold with required distributions. And after looking at their situation, my feedback is almost, you don't need to worry about doing a whole lot. You're going to be just fine without conversions. So make sure that this isn't me saying don't worry about it. This isn't me saying it's not going to apply to you, but it is me saying that a lot more people are worried about this than necessarily need to be sometimes. And then fourth, finally, is consider what you can do. There are some things that you can do to mitigate some of this. Number one is, could you do qualified charitable distributions? Look, if giving is a part of your value system, if giving is a part of what you do, if giving is something that you want to be able to continue to do throughout retirement, one way to offset the implications of required minimum distributions is to implement qualified charitable distributions, which is instead of you taking that RMD, paying taxes on it, and then giving it to charity or giving it to church or giving it to whatever you care about, just give it directly. If it goes right from your IRA to the charity, there's no taxes to you. There's limits on this and how much you can do, but that's one good way to mitigate this if giving's part of what you do and you have concerns about RMDs. Another thing that you can do is we'll talk about asset location of where do you hold different asset classes that you own. One thing you could do is, do you put your bonds in your IRAs to manage growth? So do you intentionally want to keep the growth of your IRA low? If so, whatever the amount of your overall portfolio that you determine should be in bonds or cash or conservative investments, maybe put that in your IRAs. What that's going to do is it's going to limit how much your IRAs might potentially grow to. So big caveat with this, don't put bonds or cash in your IRAs just to limit the growth there. But if you already have an asset allocation strategy that says you should have X amount in stocks, and X amount in bonds, and X amount in cash, and broken down however you think it needs to be broken down for your situation, of those amounts, what you've already predetermined to go into bonds or to cash, you try to fill up your IRA balances first with those amounts to manage the growth on your IRAs. Because the more your IRAs grow, the more your required distribution will be. So think about it that way, of how can you use asset location to manage the overall impact of your RMD. And then finally, one thing that you can do if you're already at that age, you're saying, man, there's just not a whole lot that I can do to really get around this, reframe this. It's really not as scary as you might think. It's almost like some people do anything they can to get rid of that RMD because they don't want to pay taxes. And I'll say to them, look, if you were still working and I was going to offer you a bonus for a job well done, would you turn that bonus down because of the taxes that you'd have to pay on it? Of course not. So yes, ideally we want to mitigate the tax impact of that RMD. And yes, we want to do good tax planning to lower the lifetime taxes that you're going to pay. But some people are so concerned about receiving that RMD where I say treat it like a bonus. If you've done everything you can and it's just now a matter of fact that you're going to receive that RMD, it's a good problem to have sometimes. Treat it like a bonus where yes, you're paying taxes on your bonus, but a bonus is still a bonus. So go spend it, go reinvest it in a non-IRA account, go give it away, go do something with it. But don't let the tax picture be the all-consuming factor of your retirement plan. Do what you can, be smart, be prudent, but at the end of the day, it's going to be what it's going to be, and make sure that you're making the best decisions with this as opposed to letting the tax picture be all-consuming. So I hope that was helpful. Carl, thank you very much for your question. And thank you to all of you who support the show. I truly, sincerely mean that. Thank you to those of you who have left reviews or sent me emails or left comments on YouTube. It's just really fun to see how many people are tuning in. And as always, I appreciate you listening, and I'll see you next time.